There's a lot of misinformation about trusts, how to use them, how to set them up, and what's the actual real benefits for the trust. Today, in this video, I'm going to dispel all the misinformation and give you the real facts about how to actually use the trust, what is the correct structure for the trust, and what are the real pros and cons in such a detailed, nuanced way that it gives way better information than any other content creator out there. And the reason I know this is because I've used the trust myself personally, and for the hundreds of clients that we've gone through together, helping them set up their property portfolio using the trust structure. And it's very important that you understand what it's actually used for and the detailed nuance that you must know how to set it up. So let's get straight into it. Today, I'm going to reveal how people buy unlimited properties using trusts. So you might hear on the news how people are buying 5 to 10 to 20, 30 properties, right? You might see this a lot in the news. But the reality is that 99% of property investors have less than 5 properties, right? Now, it's not because they can't afford the properties, not that because they don't have enough income. It's because the banks won't lend them the money. Because the way that the banks view your income is completely different to the way it is actually in reality. And I'll go through this with an example. There's 2 main rules that they cover. One is that banks shade rental income. They shade rate your rental income between 10 to 20%. 2, they also add a buffer rate. They add a buffer rate of around 3% on that. So here's an example of what it looks like. Let's say your rental income is $2,600, right? And because of the bank's rules, it's shaded by 20%, which means that you're only taking $2,080 under the bank's eyes. Now your mortgage repayment, let's say, is $2,000 for that same example. With the bank's assessment rules, they add 3% onto your loan, which means that your mortgage payment is $2,695. So in this example, you were positively geared from $600 and now you become negative geared of $615. And this is not even factoring in the strata costs, insurance, maintenance costs, agent fees. So you can see why even though someone buys a positive geared, because the bank's strict assessment criteria, they become negative geared. And the reason why banks set this up is just to protect themselves. They want to be conservative rather than not conservative, so that they make sure that you can afford this loan regardless of what happens. Now, and in most cases, most investors, when they're buying properties, majority of the investments will be negative geared. And the reason is because of the high interest in this current climate, and because most investors usually use between a 5 to 10 to 12% deposit. So as you can imagine, if something that's positive geared becomes negative, something that's negative geared becomes even more negative. And this is why majority of investors are capped out between 2 to 3 properties, unless you're making more than $500,000 or $1 million, which majority of investors are not. Majority of investors are making about 100 to 200 grand. And that's why majority of investors can only buy 2 to 3 properties, even though they can afford it on paper. Now, over time, properties become positive geared, right? And that's the thing that most investors have to wait for, but that could take 5, 6, 7 years before that happens. In that time, prices could double, which makes it very impossible for you to re-enter the market. Now, the solution to this is you buy through a trust or company structure. And I'll explain why that's the case. Now, before I explain why it's the case, you need to make sure understand what is a trust or company structure. Now, without going into the huge details and nitty gritty, it's just a legal entity that holds the asset. So instead of you holding the asset under your name, you hold it under this legal entity that helps protect your asset. Now, we always try to preference under a trust rather than company because you get a CGT discount. What that means is, let's say you made 100 grand profit, you get a CGT discount on that if you buy under the trust if you hold it for a year, which isn't the case if you do it under a company. Now, with the trust, there's 2 main structures, the discretionary trust and there's a unit trust. And I'll explain what the difference between the 2. Discretionary trust means that you can control how much money and the profits for the distribution, which means that let's say you made 50 grand profits, you can choose to put 10K to yourself and 40K to your wife. With a unit trust, it's fixed, which means that if it's set up 50-50, you cannot change it. 25,000 goes to you, 25 goes to your wife. Now, why is this important? For tax purposes. If you allocate more income to you rather than your wife, you can reduce your tax bill or help minimize the amount of tax, vice versa. And you need to make sure that this structure, this trust or company, is only used for property investing, which means it cannot be a company or trust setup that runs as trading. What that means is it's making money besides property investing. It has to be for property investing only. Now, let's go through a real life example of how important it is to have this correct structure at the beginning. So let's say you have a person buying under their personal name and they're earning about 200 grand and they want to buy something for around 750 with a rate of $600 a week. Let's say they buy the first property and the borrowing capacity is $1 million. What happens is, because of the bank rules, when they buy their second property and because of the tough, stricter servicing criteria, their borrowing capacity is 500. Now, when they want to buy the third property, their borrowing capacity is 200,000. And at this stage, you know that as slow as you decrease, it becomes very difficult to find something in that price range, and you soon being capped out around property 3. Under trust, you notice in the same example, right? They can buy one property at 800,000. They can buy a second property at 800,000, and they can buy a third property under 800,000. And it's because the banks will ignore that property. Banks will ignore that property under the trust as long as the property is self-sufficient, right? And what that means is that the income of that property covers the expenses. The income covers the expenses, and that means that the banks ignore that property, ignore the income, ignore the debts on that. And the way you verify that is through you get an accountant's letter. Accountant to verify that this trust is self-sufficient. Now, not all banks allow you to do this, only some banks. And you can contact someone like me, a professional that can help you find which banks, because there's almost 50, 60 options out there. And instead of you spending all that time, I can help you find the right banks that allow you to do the structure. The second thing you notice for the example is that your borrowing capacity is reduced by 20, 30%. So you can see here, in this one example, you could buy up to $1 million. Here, it's 800,000. The reason why is because of negative gearing. So when you buy it under your personal name, you can have negative gearing applied to your income. When you buy under trust, the negative gearing cannot be applied to your personal income. It has to be applied under trust, which means that you cannot borrow as much because you're not getting that tax offset against your personal income. Now, who is this trust structure ideally for? It's people with good income and cash flow, right? Because this allows you to buy multiple more properties than you are naturally allowed to buy under normal circumstances. So in order to mitigate that risk, you need to have good income to make sure. Otherwise, the problem becomes if the interest rates go up, right? And you have too many properties, you could be in a huge financial position where you are financially in a really bad position where you are forced to sell multiple properties, right? It's also good for people with high risk because by doing this, you get higher risk and a higher return because instead, let's say the property grow by 10%, instead of having 3 properties at half a million, so you're making 150, let's say you have 5 properties made at $500,000. So now you're making 250 instead of 150. So you're making $100,000 more profit every year. So it's perfect for that. And it's perfect for people that actually want to build long wealth by doing that structure. Because if you only have 1, 2, or 3 properties, you might be forced in a situation down the track. You might have to sell one property, pay out your debts. You might have to give one property to your kids. And then you're left with one property to survive and not much passive income. By having this trust structure, you can build 5, 6, 7, 8, 9, 10 plus properties to build your wealth where you can earn passive income to survive on. Also, you can sell a property to pay out all your debts and also give a property to your son or your daughter in the future. This structure is not for people that are not making good income. What I mean by good income, at least you have to make a household income of 150, 200,000 plus. It's not for people because there's high cost involved. Having a trust structure costs money. Costs about $2,000 to set up. Costs about $1,000 to maintain. And it's not even factoring other bills like land tax that you have to pay on top of that, which means that's not good for people that are not earning good, strong income because there's too much risk. It can lead you in a really bad, vulnerable position. Okay? And it's for people that are not risk takers, right? Because this is mean that you're taking way more risk. If you're in that position, you can compromise yourself. Now, if you are wanting to implement the structure, how do you sort of implement it, right? And it's very important that you understand this principle because if you implement this structure at the wrong way or the wrong time, it becomes redundant. And I'll explain why. The ideal structure to have, if you want to maximize your borrowing capacity and buy as many properties as you can, is to have your first investment as a trust, then second as a trust, third as a trust, etc., until your last property is your primary residence, right? And I'll explain why this is the case. Because if you set up as the other way around, where you set up your first property as your primary residence, and then you buy your other property under trust, it isn't efficient because your first property, which is under your personal name, has taken all the borrowing capacity, right? Which means that if you buy that first property, now all your borrowing capacity is under your personal name is all gone. Now you can only afford to buy properties with 200 or 300,000 or lower amount. The ideal structure is to buy under trust because the debt is ignored each time. It's very important that you have this up because most people that buy under PPR in the first place now want to implement trust. It's too late or there's not much, the borrowing capacity isn't enough for them to buy into the market. So it's important you understand this principle. And another thing you need to understand is one property, one trust. So here are the pros and cons of buying under the trust structure. And it's very important you understand this before you take this strategy because you need to understand we're dealing with your financial future. We're not dealing with you buying a $500 or $200 or $100, whatever, a couch or whatever. This is dealing with hundreds of thousands of dollars and sometimes even millions of dollars. If you make a wrong decision, you can financially stuff yourself. So it's important we understand, go through the pros and cons. So the pros, one, you can build a property portfolio wealth, which we've gone through. You can make more money. You can compound your wealth way faster than one or two properties. The second pro is asset protection, which means if anyone comes after you, if you have the trust structure, your property is protected from being sued. The second one is tax efficiency, right? I won't go into detail, but what allows you to do is that having the trust structure allows you to distribute the profits, which means that there's ways to help minimize your tax. Now, the other pro is that there's actually land tax saving, especially if you have multiple properties. And the reason why is that if you have multiple properties under each trust, the threshold is renewed for each property, which means that instead of being stacked all on one, you can have multiple properties all under the threshold, which means that you can minimize the land tax. The other pro is that trusts allow, as I mentioned before, you allow CGT discount. And another one is that lending rates are the same as if you were buying under trust versus buying under your personal name. So you're not paying more for buying under trust. Now, the cons. The big cons are the setup costs. You are paying between 2 to 1%. The big cons are the setup costs. You're paying $2,000 per trust. And you're also paying $1,000 to maintain the trust every year. Now, that might not sound a lot, but if you have 5, 6, 7, 10 properties, that's $20K to set up and $10K to maintain every year. Okay. The other con is the land tax for 1 to 2 properties is higher, right? I'll go through this example down the bottom, but it can be a big decision making about how much the other con is the land tax for 1 to 2 properties is higher, especially for that first 2. I'll go into detail down the bottom later on, but it can make a big decision in terms of your cash flow analysis. The other con is there's no negative gearing applied. The other con is that negative gearing is trapped in the trust. What that means is that the trust is making a loss. Let's say it's making a loss of $10,000 a year. You cannot offset that against your personal income. You have to wait until that trust makes profit before you can offset that income. And that might mean you might not have a tax saving of 3 or 4, 5K, assuming you made a 10K loss. That's the difference of buying under the trust. The other massive con, this is a big one, is that the domino effect. So we had an example of a client, had multiple properties on the trust that are all under 2% during COVID. What happened was when the banks... Can
you just say that one more time? Under 2% yield.
Yeah.
Right? Yeah.
Okay. So I'll explain the domino effect. And this is the big one. We had a client that had multiple properties that were at an interest rate of 2% on the trust. And this was during the COVID time before the RBA made those decisions. Now, what happened was RBA increased the rates 13 times. Now, you can imagine your rate is 2%. Now it's almost 6.5%. So as a result of that increase, they have this huge problem where all the properties are now negative gear and they can't afford to hold them. And as a result, they're forced to sell a couple of properties. So it's important that you need to understand that this is for people that want to have good cash flow and have that capacity to withstand events like an increase in rates, just in case. It's very important that that's the case because you don't want to be forced in a position where you have to sell property in a market that you don't want to sell. Now, as I mentioned, the land tax, this is the thing. So the land tax is, gotta keep this in mind. Let's say on a 300K land. Now, a property that's worth 300K land doesn't mean it's actually worth 300K because with properties, there's land plus building component, right? And usually a property that has a land component of 300K normally worth between 5 to 600K because the rest of it's building. It's added combined value. Now, in terms of land tax, if you buy in New South Wales, if you buy on the personal, you pay 0 land tax. If you buy on the unit trust, right, you pay 0 land tax. If you buy in discretion, you pay $4,800 land tax. Victoria, you pay 0, 0, 0. Queensland, you pay 0, 0, 1,500. South Australia, WA, Northern Territory pay 0, 0, 0. So the land tax thing is a problem to a certain extent, but it's not as big of an issue because most people can buy under unit trusts, right? And most investors are not buying properties million plus. They're buying something between 500, 600, 700K because it's not economically viable to buy such expensive property because it becomes very difficult to maintain and hold in terms of the yield. Now, these are the costs. But when you do this cost, you have to work the benefits. The benefits are, if you buy something for 500K, it grows by 7%, you're making about 40 grand a year. If you buy something for 600K, it grows by 7%, you're making about 45 grand a year. You buy something for 700K, it grows by 49,000 a year. And this is compounding, which means that over time, it adds up. So sometimes this is the cost of doing business. Sometimes you got to pay a little bit to gain a lot more. Okay. Now, this is the structure. Now, if you are to do this trust and you really want to go into it and actually set up, here's some important ways to set up it correctly from the get-go. Because if you set up incorrectly, you have to pay more for the accountant to fix it up. The first one is you want to make sure you have a trust. And then this could be, let's say, ABC Family Trust. Then you want to have a corporate trustee. So that could be ABC Pty Limited. It's important that you have a corporate trustee, not an individual trustee. Because if you do an individual trustee, you do not get the same benefits as buying under the trust. This whole process becomes redundant. You may as well buy under your personal name. Then you want to have person A or person B as the director and the beneficiary and the guarantor. And when banks review this, they just look at your income. They do not care about the trust because the trust and the company are not trading, not making any income. They just look at your own income. Now, 2 main important questions I get asked a lot. How do I make my trust profitable? 1, you take interest only rather than P&I. And the reason is interest only, you save a few $100 to $1,000 in paying less. You only pay the interest of the loan, not the interest in the principal. Number 2, have a larger deposit. Instead of having a 5% deposit or 8% deposit, try to get 20%, 30% deposit by using the equity of your homes. That means that these properties are easier to maintain and more likely become profitable for you rather than waiting long time. The second one is don't buy in properties that have very low yields. Don't buy properties that have 2% or 2.5 or 3% yields. Aim for something above 4%, 4.5, 5%, 6% yields because then it becomes easier to hold. But in keeping that in mind, you got to make sure that the capital growth is there to justify that. Do not just buy properties for the sole purpose of decent yields. And the last reason is over time, properties become profitable. Over time, as the income, the rents go up, as the mortgage goes down, it becomes profitable for you to maintain. Okay? Now, another common question we get a lot, all the time. Hey, Wilson, I'm fully capped out. I am fully maxed out. What do I do in this situation? I really want to implement the trust, but I'm fully capped out. So you've got a number of options you can do. 1, you can move the property from your personal name to the trust. I do not recommend this. There's 2 reasons why I do not recommend. 1, you're going to pay stamp duty, again, based on the new value of that property when you convert from personal name to a trust. 2, you have to pay CGT on that profit that you made. When you change, you have to pay 2, you have to pay CGT when you transfer from your personal name to trust on the profit that's made. So let's say the property made 200 grand profit. You have to pay CGT on that, even though you're transferring from your personal name to yourself. Even though the ownership is to you, you still have to pay that as taxes. If you're fully capped out, what you can do is sell property. Sell property to relieve your borrowing capacity and then look to buy under trust. Or what I see very common nowadays is they're looking at renting out rooms or renting out the property and moving back to their parents or building a granny flat at the back to live in and then rent out the home house. Sometimes you have to make sacrifices if you want to get ahead in life. The other option is if you're maxed out, you can explore second or third tier lenders. And the reason why second, third tier lenders can sometimes allow you to borrow double or triple than under the first tier banks, like the big banks. You can borrow $500 million more under a second, third tier lender and pay a little bit of extra, but at least you can make that money. You can make that capital growth to make it worthwhile, make that profit. Another way is debt recycle. So what you want to do is convert all your non-taxable debt into taxable debt, which allows you to borrow more. And the reason why is because you can reduce your tax and taxable amount, which means that you can borrow more for the future. And obviously, the last one's time. Obviously, as you can imagine, as you make more money, as the debt becomes lower, over time, the rents become increased. Now, the reason why I have this video is there's a lot of misconception about trust. And it's very important that I made this video just to cover all the points for you. When you're making a decision about property investing, where you want to implement the structure, you need to understand how to implement, why you should implement, and where this is most importantly, where this is suitable for your investment strategy, right? Because if you implement the trust and you're not someone that can actually tolerate the risk involved, then it can be almost financially suicide by doing this. But if you're someone that can do this, then this is perfect for strategy for you. And if you want me to help you, right, instead of navigating through all this, I can help you navigate all this for you. Just reach out to me. We have the right team that can set up the loan for you. We have the right accountants that can set up the correct trust structure and help you with the accounts layers so that you can build your property portfolio and build your wealth. So reach out to me if you need it. There's a link below. Just click on that link. Thank you so much for your time. Appreciate it.